Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The NASDAQ is celebrating new highs. The S&P did well. The Dow, not so much. He tells us sentiment is running at extremes. Ross checks out the U.S. and Canadian dollars, crude, and precious metals. Is Bitcoin about to skyrocket? We'll find out when we chat with InsideTrackTrading.com President Eric Hadik. He examines the cycles affecting cryptos, crude, and natural gas. He believes cycles are telling him a three-way currency war is about to break out. President of Venable Park Investment Council Incorporated, Danielle Park, tells us about the impact of the latest Bank of Canada rate hike, inflation, and why it's about time for a major Canadian bank to change its slogan from "You're richer than you think." We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
Ross, any big news from the stock markets this week?
Hey, how about new highs again for the move? I mean, here we are. We had a really overbought 3 weeks ago, spent some time moving sideways, and now some of the big name stocks are on the move again. NASDAQ, closed up here nicely on the week. You got the S&P, the same type of thing. It wasn't quite as strong at the end of the week, but my gosh, this market's just climbing a wall of worry right now. Got lots of things to be concerned about. The put-call ratio is down at extremes that we haven't seen in a couple of years here. We take a look at the some of the other oscillators that are out there, the sentiment indicators starting to reach towards extremes. But until we roll over and take out a support, you just don't want to fight the trend. And, we've had some new names kick in here. The crypto area has come to life. Coinbase had a nice breakout at the early part of the week and had a really good run for the rest of the week. Probably overdue for a pause right now, but, that's an area that one might take a look at again. It's based out over a span of the last, I would say 12 to 14 months. So it's got the potential for the accumulation that went on to have a decent upside move there.
What's happening with the U.S. and Canadian dollars?
Currency side, it's been one of those stretches where it put you to sleep almost on the dollar index. It was stuck between 100 and 104, and for the better part of this year, when we were getting short-term buys and sell signals, there was a sell signal here at 103.5 a week and a half ago, and most people played it down, said, well, you probably just go back down to test support. Well, we didn't do that. We've taken out the support. The dollar index is at 100 or par, if you want to call it that, at the end of the week. And, it's broken out of this consolidation it's had since January. And if you measure the height of the consolidation, you could easily get a target down around 98. Could go further than that. Once the dollar gets in motion, it tends to have a fairly prolonged move. If you look back at it over the last, not a year or two, but over the last many years, once those trends get in motion, the pauses are just a bit of a refresh, and away she goes again. So we'll look for, I would say, 98 and a quarter is a reasonable target on this move right now. Last week we talked about the commitment of traders numbers and how they had been really bullish on the Japanese yen for 2 weeks. Well, the yen had its best rally this week since March, up over just about 2.5% during the week. For a currency, that's a great move. Probably a little overbought right now and due for a correction. And if we look at the other currencies, the euro, the British pound, good weeks there as well. So it's not so much even that the dollar is just falling as it is strength in other areas. The weakest currency of them all is the Canadian dollar. It was up just over 1.5% on the week, which does not compare that well with what's going on in the other currencies. So you've got to be watching for that one to hold that 75-cent level that it broke out from. If it doesn't, things could get a little rough here for the Canadian.
What's going on with gold?
Gold had a really good week. So did silver, more so in silver, but. We've gone from an oversold reading on both of these a week and a half ago. A good rally, though, at this point, and I think we're now up to pretty good resistance levels. Gold has retraced about 38% of its decline since the high in May. Silver's retraced to over 62%, the Fibonacci number, since that same high, and overbought at the end of the week. I would love to see us go down and make one more test of support before I think that we can have a decent rally out of this summer, but one more test of support would just be ideal at this point. Saw the commitment of traders numbers on Friday, and there's nothing dramatic in there, so there's no leadership that we can look at from that one. And speaking of commitment of traders, the British pound, at this point, we've got numbers there. When you take a look at the commercials and the non-commercials, the speculators, they are at extreme levels that we haven't seen since 2007, which was when the pound was over $2 US, and it went through the process of rolling over up there. So I would be watching the British pound through the summer here to see if it starts to form a minor top, maybe on the daily charts, and you start to see a bit of a roll. You could probably look at the MACD as an oscillator. If you get a sell signal up there, there's going to be some pretty good potential on the downside because there are just such overweight positions by the speculators and by the large funds because there's been a decent trend here. When this reversal happens, it's going to put some big changes on the bottom line for the profitability of the spec traders.
Anything happening with crude?
Crude last Friday was just up kissing against its 20-week average, which we had looked at as a key point. During the week, the rally was strong. It continued through that resistance level, and at this point, we closed off the week at 75 and change, having been up to 77. And be looking for that $72 level to probably be retested here in the summer. And if that can hold in here, this could end up looking like a pretty decent base.
Ross, thank you so much for the update.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Thanks for having me back, Jim. It's great to be here.
Eric, you've written a lot about a new phase of currency wars and a 40-year cycle that governs these. Can you explain that and what it might mean for gold, cryptos, and the U.S. dollar?
Yeah, that's a topic that I've been writing about for probably the last 10 years or so. But at its very core, or the most general explanation, is this very unique repetition on a 40-year cycle basis of what I call a currency war. It becomes inflamed at these transition points within this 40-year cycle, and that's the battle between hard currency and paper currency. And in this last phase, you've had digital currency entering the fray as well. But if you go back to the founding of America, and even well before that, you can just see this 40-year cycle. I mean, it dates all the way back to the Spanish pieces of 8 in the 1200s, and it just is a very consistent cycle that is a very natural cycle. There's other reasons for that, but each time over the last couple hundred years, at the culmination of one of those cycles, you'll see this battle really come back to the forefront. And again, it typically is between gold and silver versus fiat, the U.S. dollar. But in this last phase, cryptos also entered that whole, made it a three-way battle. But what I was describing was a culminating phase of the last 40-year cycle from 2016 to 2021. And if you go back, like I said, to even the founding of America and the experimentation with the Continentals between 1776 and 1781-82, a disastrous experiment. That was a kind of the start of this recurring theme where every 40 years later in 1816 to 1821, then 1856 to 1861, where you had the government reducing the amount of silver in coins and a battle between gold and silver and paper currency then. And fast forward to 1896 to 1901, and that was the battle to restore the gold standard in America. And then in 1936 to 41, following the outlawing and confiscation of gold. And then 1976 to 1981, and the Jamaica Accord in 1976, which basically I like to just call it the global divorce decree from gold. And that led to a super inflationary period in the late 70s. And again, 2016 to 2021, what I described as my expectations back in 2014, 2015, was that we would see gold enter a new bull market in 2016 and see a major surge up into 2021 when it would plateau for a while. And that was based on a lot of other indicators and cycles as well. It's not just this 40-year cycle that I'm looking at and suddenly putting all my eggs in that basket. That's more of a backdrop for a myriad of expectations, that many of which came to fruition over the last 5 to 10 years. And we've now entered, in 2022, we entered a new phase of this 40-year cycle. And I think the battle is going to continue to rage, and that we are going to see it even take to a new level in the coming years as the dollar and dollar index goes through what I expect to be a major topping phase this year, maybe even into early next year. But it's already reached major upside price targets. So the intraday, intra-week high could be in place, but it usually takes a period of time for that rolling over and topping process to unfold. But I think that is going to pave the way for some pretty significant moves both in gold and in cryptos. And what I've kind of explained to my readers is I compare this, what's now a three-way battle, almost a little bit like an old game of rock, paper, scissors. But more specifically, I take it to an algebraic equation where if you just have the three variables and you say A times B equals C, where each of those letters represents one of the combatants, either paper fiat currency, hard metal currency, and or digital cryptocurrency. And it kind of it gives the basis for how you see the interplay between those three entities play out, that there actually is a very unique correlation between gold, Bitcoin, and the dollar, but it's in a constant state of flux where when you have, like right now, the dollar triggered a new sell signal in early July and showed that it should drop to new intra-year lows. Well, then the question is, okay, is gold going to benefit more? Is crypto going to benefit more? And it's usually an alternating thing. You rarely see them both surge at the same time because you've got different investors or different preferences as far as an anti-dollar vehicle, something to hedge against weakness in the dollar. And again, it comes down to that A times B equals C type of equation. And I go into it in detail, how I quantify the magnitude of trends and of acceleration within those trends, and how this gives some good indication of what to expect from gold, Bitcoin, and other cryptos, and the dollar index at different times in the market. And just for instance, gold signaled a low, an intermediate low in late June, early July, and triggered some buy signals there that were saying it should get a quick little surge into this week, into July 12th to the 14th. Well, at the same time, Bitcoin had already seen a good surge into late June, and it went into a consolidation phase. So you've got the dollar in the first part of July, dollar starting to sell off, gold getting a good rally, so Bitcoin just kind of bides its time. Well, in this July 11th, 12th time frame, my work's showing that Bitcoin is getting ready for another quick surge that I think could take it up to 35,000 in a very short period of time. And so it wouldn't surprise me to see gold kind of complete its quick bounce, then gold start to consolidate, and that give the opportunity for Bitcoin to surge from, say, July 11th, 12th into next week. In fact, I just completed an alert for my subscribers that detailed some specific upside targets and timing factors for Bitcoin, and it goes along with this dollar-gold correlation and scenario that's unfolding. So all that to say is that I think we're entering another phase on a broad picture perspective, big picture perspective, where you're going to see these currency wars really rage in the coming years. And there's a couple of specific time frames over the next 1 to 2 years when I think you could really see some accelerated moves.
In March of this year, you detailed a couple buy signals in gold and forecast it to rally into early May. You also explained why that would reinforce a future cycle into late 2023. Can you update that outlook and explain why you thought early May would time a decisive peak in gold and silver?
Yeah, that's been at the core of a lot of my short-term and intermediate analysis since then. But as you came into this year, came into 2023, I started out looking at some of the broader kind of multi-month and larger multi-week cycles. And when there's the strongest convergence of those cycles looking out in a given year. And so coming into 2023, there were two really the greatest synergy of cycles. The first was in early May, and the second was in late October, early November, when I thought we would see very significant multi-month peaks in gold. And so once you kind of have that backdrop set, that helps you kind of put current market action into perspective. There were also a couple of key cycle lows expected in the year of 2023. And when gold in early March triggered a weekly buy signal, then confirmed it with a short-term daily buy signal, it reinforced the ongoing outlook for gold. And at that time, I started publishing and kept repeating that early March buy signal should trigger a run-up in gold into the first week of May. In fact, even daily cycles were honing that outlook, projecting May 3rd to the 5th as being what should be a multi-month top in gold. And like I said, this was published months in advance, so it's not just curve fitting it now. Just kept reiterating that gold should rally up and should peak on May 3rd to the 5th and then undergo a pretty serious sell-off. Price targets also took form early on, where gold was expected to shoot back up to its high around 2080, silver up to about 2650. And both those metals rallied right into mid-April, then they kind of plateaued, and then they gave these final spikes up into May 3rd, 4th, 5th, attacking those target levels. And when you get a market adhering that closely to both the price and timing outlook, it really spurs me to stand up and take notice for what is expected to come after that. And gold and silver reversed lower and started to sell off. But the significant thing about that was that the longer-term cycles I was looking at, if the early May cycle high was accurate and gold and silver fulfilled that, that would powerfully corroborate and reinforce the expectations for a future peak in late October, early November. So that's why that took on an added level of significance. And in between, I think that we're going to continue to see a lot of two-sided trading, but there's a specific time frame coming up in August when gold and the mining shares indexes, the XAU and the HUI, just have this uncanny and very tight range and convergence of cycles that are telling me that's when the next important low should be. And they've even kind of already started to identify specific price targets for that time frame. So if, assuming that they adhere even semi-closely to that expectation, I think there could be a really good buying opportunity at that time. But price action and other technical indicators need to reinforce that and need to add credibility to that outlook. That's, again, more of a broad stroke expectation, but it's just been kind of interesting to me to see how many things are lining up in that August time frame. And again, the same alert that I just completed on July 12th was detailing a lot of the cycles that are playing into that. So it could be an interesting time for gold and silver, the XAU index, looking out over the next 3 to 4 months.
Do you have an update on the Bitcoin buy signal you published in mid-June?
I am still looking for. Back then, I explained, in fact, from mid-April until mid-June, everything just kept telling me that Bitcoin needed to sell off and test 25,000 before it would be in a position to see another pretty strong rally. And we finally hit that level in mid-June. In fact, I did a special publication on that, talking about crypto cycle continuation was the title of it. but it was explaining how Bitcoin was just really moving in lockstep with these swing points and these cycle and cycle progressions that had already kind of manifest themselves for the middle part of 2023. And so once we got that test of 25,000 in mid-June, along with some other indicators, it triggered an intermediate buy signal in Bitcoin. And the first target was to rally right back up to its recent highs, which were around 31,000. It did that and then consolidated, as you often see when you get a sharp move like we had in the third or fourth week of June there. Then the market needs to kind of settle down for a little bit and create a new plateau from which to catapult higher from. And so we've been going through that. As I explained a few minutes ago, there's the correlation to the dollar and to gold in there. But just looking at Bitcoin itself, there's a moving average channel that, that I follow very closely. And when a market has a quick surge like that, often it waits for this moving average to start to catch up underneath it. So as the price of Bitcoin is kind of going sideways for a couple of weeks, this moving average is starting to gain, and it's just getting up to Bitcoin's current price right around the 30,000 mark. And along with some other indicators, it's telling me that we could see a second quick, sharp rally from July 12th into July 18th to the 20th. And that Bitcoin could see a $5,000 surge there from 30,000 up to about 35,000. But there's a lot of headwinds coming into play up around the 35,000 level, and also around that July 18th to the 20th time frame. And not to keep beating a dead horse, but this was also part of the this alert that I did and detailed how all these things are coming together over the next couple of weeks, and some of the specifics that could be coming into play for Bitcoin looking out next week. So the buy signal is still in effect, and I think that that there's some more specific targets coming into play between 34,600 and 34,900, so right just below that 35,000, but wouldn't surprise me to see an intraday spike above 35,000 if it is culminating at that time.
Where does the euro fit into this whole scenario?
The euro is kind of an interesting outlier there, and I think that it is actually going to come into more focus in the third quarter and fourth quarter of this year. There's some geopolitical cycles that I'm looking at in the not-too-distant future that could certainly have an impact. But you've also got a little bit of a lagging situation where when things with the dollar, you've got signs of inflation cooling, and you had the pause in interest rate hikes at the last Fed meeting. You've got the ECB still in that rate hike cycle, and that's the type of time too where you'll start to see a little more interest in the euro, even as the dollar is going through a buy the rumor, sell the fact type of thing. That it rose on the interest rate hikes and has been retracing over the last 6 months as those hikes neared a crescendo. And there's other factors that I'm watching in the euro that tell me between August of this year and February of next year could be some interesting times for the euro.
The energy markets are looking, as some people would say, interesting. Can you explain why you thought early May was likely bottom in crude, and how high should it rally? Also, has natural gas confirmed your early June cycle low?
Yeah, all of the energy complex is kind of corroborating what it was showing in early May through early June. I'm going to answer those questions in reverse. Natural gas fulfilled a lot of monthly, weekly, and even yearly cycles in early June, but it has not yet confirmed the major bottom. I need to see a weekly close up above 291 in the September natural gas futures, and a couple of other things come to fruition in order to confirm that low. So far, it's held for a month and a half, and I would expect it to continue to hold. But again, that's where price action and more specific technical indicators have to come into play to validate those cycles. So natural gas is certainly in a bottoming phase, and there are some short-term indicators that if they're triggered in the next maybe 3 to 5 trading days, that natural gas could see a quick surge up into the first week of August. But that would only be the first phase of something bigger that I expect. Going back to the discussion on crude and the products, the other energy markets, crude was not only coming into the convergence of some weekly cycles and monthly cycles in May, but the way in which it retested its low, set a double bottom, did not break through that on monthly basis. It had some of those similar averages coming up to meet price as support, the averages that I was just talking about with Bitcoin, except Bitcoin I was referring to those averages on a daily basis, and in crude here I'm talking about on a much longer monthly basis. But you had this rising support coming up under crude and saying that it should be in a bottoming phase. But just as important, all along I've been looking for crude to see its next peak in September of this year. And in order to see a peak, you need to see a new rally from the correction that it had. And so that's what I was kind of viewing as the backdrop, as the overriding outlook for energy markets. And once we tested that support and started to hold it, then some shorter term indicators started to kick in, and more recently some weekly and intermediate indicators. And it's been showing me that crude should head back up to at least the $82 a barrel level, but there's significantly higher potential upside if that level is broken in between now and early August. So I think the energy markets are in another up phase here, but there is certainly a powerful and a significant cycle convergence coming into play in the later third quarter, early fourth quarter of this year. It could have some significant ramifications for energy prices looking out over the next 6 to 12 months or longer.
Eric, before we go, maybe tell our listeners why Inside Track has 2 eyes inside of the word inside.
Well, inside when I first started putting together the service back in the 1990s, I wanted something that would describe the market complexes that I was really focused on. Now that has spread out a little bit since then, although that still is the core. And so the letters in inside were representative of the different market complexes and entities that I was focused on, from interest rates and inflation to stock indexes, so the IN and the SI. Then the additional I was the interest rates. The IN was inflation, stock indexes, interest rates, the dollar, which included all currencies, and then the E was for energy markets. So it was an acronym, and it's kind of held through to the present. Although, like I said, I certainly it branched out from those core markets and incorporated others. But that's really the distinction. In fact, when listeners want to find out more information, they can go to our website, which has that same extra I in the middle of InsideTrackTrading.com, INSIIDE, TrackTrading.com, and you'll find other things related to our services with that same spelling of inside.
Eric, thank you so much for chatting with This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from California. Coming up, Danielle Park, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Danielle, welcome back to This Week in Money.
Oh, thanks for having me, Jim.
This week, the Bank of Canada raised its central rate by a quarter point. How high could interest rates go? And when the bank stops hiking rates and moves to cutting rates, what could happen to bond and equity prices?
Well, they've been hiking rates, as you know, Jim, for the last 16 months, since March of 2022. So it has already been the sharpest rate of increase in many decades of monetary policy. And that, by the way, that movement from 0.25 to 5% that the Bank of Canada has done, and in the U.S. it's from 0.25 to 5.25 that the Fed has already done, does not include the quantitative tapering, which is the rolling off of assets from their balance sheets, which continues to go on month after month and is now definitely reducing liquidity in the financial system. So when you couple the sharpest increase in history, or for many decades, with quantitative tapering, you've already seen cardiac arrest of financial shock to the system. And so the question is, the fact that the patient has still continued to move about has confused many people, but they don't understand the lag effects. I've described this many times. There's typically a 12 to 18 month and even 24 month lag in some cases for rate hikes or Fed tightening to filter through the main economy. And that means that the tightening that began 16 months ago is in many ways just starting to be felt in the overall economy and in the credit contraction that's going on throughout both the corporate and the household sector. And so when you ask how much further can they hike rates, if you listen to the central banks, they will say that they intend to hike further. Certainly the U.S. Fed has indicated they're expected to hike another 0.25 in July, and then potentially another 0.25 by the fall. But here is where it gets much trickier, right? Because the data is profoundly negative. The leading indicators have contracted for 14 consecutive months now, suggesting, and we've never seen a contraction like that where you didn't have the U.S. going into a recession. We have all the economic indicators out of China are completely dour. We have the biggest drop in exports and imports. We got that data this week since the March 2020 COVID downturn. So, that's the U.S. and China are the first and second largest economies in the world, and they're showing extreme signs of downturn in the leading indicators. And the coincident indicators are now starting to look pretty grim as well. Industrial production is plummeting. We have a lot of problems manifesting in the credit market. We've already seen a 30% jump in bankruptcy filings, for example, in the households. The trustees in bankruptcy who 1 year ago told me they're the undertakers in finance, they are reporting that their phones are ringing off the hook. So when you say, how much further could they practically go here? I think that the Bank of Canada is very likely at the very end of what can be tolerated, and indeed the carnage that's unfolding already, thanks to our huge amount of variable rate debt in this country. I think that's already a tidal wave of trouble that's going through households and businesses right now. And as I say, we're seeing that already in insolvency filings and in just all kinds of anecdotal evidence and the data itself of people, starting to really freak out at the horrible math they're facing, on mortgages that were, for example, taken out at 1.75% at the depths of the pandemic, and now they're facing rates as these terms come up for renewal that are around 7%, Jim. So if you do the math, and I do it every day, I always like to say the people that are very optimistic or keep insisting that the economy's brushed all this off, or that we're not going to see any, downturn, or it's all a soft landing. I always like to say, can I see your data, please? Because I happen to measure and map this every single day. So I would say that the Bank of Canada ought to stop. They've done more than enough in terms of catching up for their, gross negligence during the pandemic, where they left rates too low for too long, and that's the same in the U.S. Fed. They left things way too long, I think, because Jerome Powell was trying to get a second term, and because, Donald Trump was in at the time as president, and he was basically telling them, keep rates low, because he wanted to get reelected. That didn't work out for Mr. Trump, but it certainly worked for Jerome Powell to get his second term. And it seems that his legacy is that he wanted to be the guy who restored the world to normalized interest rates. We had that experimental phase of zero interest rates when all that money in the world went even to negative yielding debt, which made no sense whatsoever. We had a decade of absolute madness, and it manifested in all sorts of malinvestment, misallocation, bad financial decisions were made across the board. And I think that the U.S. Fed has decided that they are going to correct for that once and for all. And they don't plan to be cutting rates, if you listen to them, until well into 2024. And then even when they do, I suspect it's unlikely they'll be retesting the lower bound of the zero, the ZIRP, the 0.25 range that they went to after the 2008 crisis. I would be very surprised if they boxed themselves in there again, because I think they found that they were really out of runway when it came to once you're at zero, and there's not much more you can do. So I think hopefully the happy news, I hope, is that we've learned from the ZIRP experience, and that they won't cut rates. The overnight rate, which is currently around 5.25, may indeed get cut to something like 2 or 3 as the recession unfolds in 24. But I don't think we're going back to the zero bound. But I could be wrong. They could be absolutely non contrite or still not sorry for that mistake they made, and they may indeed do it again. But I'm hopeful, at least, that more normalized rates are here to stay. Even though that's inflicting a lot of pain on debtors, the reality is that it realigns positive financial incentives in the economy, and it's actually much better for savers, where we're getting actually decent rates now on cash deposits or, GICs and investment savings accounts and that sort of thing.
Can the economy be resilient to higher and higher debt costs?
Well, this is the trouble, right? So more than a decade, actually, of leaving rates near zero, compounded all of the spendthrift ways that people had, because credit was so easy and plentiful. Again, not only just were rates near zero, but they were doing this quantitative easing, buying of bonds and throwing more cash into the financial system so that it was overwhelmed with liquidity, and there was just no good place for all that money to go. So it went into a lot of really dumb things, quite honestly. And Canada's household debt service ratio as a proportion of disposable income is 187%. That's a record. The U.S. U.S. is only at 100, Jim, and that's already high. But they were even higher at the 2006 bubble peak and the subprime madness that went on in the cycle before that led to the 2008 recession. So in some ways, the U.S. households are in better shape than they were in 2006-07. Unfortunately, Canadian households are not, but it's not just households, it's corporations. Corporate leverage is at an all-time high. It's come off slightly in the last year because, as we say, rates have gone up. And you see a lot of junk debt was sold where junk debt, high-risk companies, traditionally they were supposed to be offering rates, in excess of 8% as compensation for the risk to investors to entice people to give them their capital, make loans to them through the public debt markets. If you're a high-risk borrower, you're supposed to pay a higher interest rate. But of course, once they pushed the risk-free rate to zero, all bets went off and all the scales were skewed, and corporate leverage went through a big explosion. So we have now got this whole world of companies who shouldn't have existed or shouldn't have persisted, but only did so because they were able to borrow money. The highest risk companies were borrowing money less than 5%, which is about, typically where, as I say, you should be able to borrow sort of the risk-free rate around 5%, which is where it is right now, actually, which is great. It's the best, the 2-year Treasury yield is north of 5% for the first time since 2001, Jim. April of 2001. So this is pretty impressive. And I will definitely hand it to, I think Jerome Powell, being the head of the U.S. Fed, led that board, but I think that the U.S. Central Bank leads the rest of the world through the Bank of International Settlements and their meetings that they have all over Europe, and they get together and say, boy, we really had quite a mess with that zero interest rate environment. Let's not do that again. Now that we've got the cover of inflation as a political cover to increase rates, let's get them up as fast as we can. And so they steadily did that, as I say, that abrupt hike. But the problem, of course, is because of the prior period. It's not the re-normalizing of interest rates. It's the period where everything was so low for so long that caused all the bad choices, bad spending, bad ideas about what you do with capital. And so now when they try and normalize, it's going to have a lot of carnage throughout the economy, and a lot of people are learning this the very hard way, which is in real time, when they're facing this just absolute cliff of expenses that they had not planned for. And as I say, we're not even into the really significant loss of employment yet, Jim. And once we get the loss of employment phase, which is, of course, employment being also a mandate of the U.S. Fed, they're supposed to try and maintain employment. So once we get into the layoffs, really, and we've started to see that the Canadian unemployment rate has come up from, less than 5 to more than 5. It's expected to go up another 1.5% or so, maybe even to 7% over the next year, and that's kind of a modest expectation of what we're seeing unfold. Average hours worked has come off significantly. That's a leading indicator of unemployment. So I think all those to say that they are not likely. We're not going to weather this storm very well. And in many ways, that's exactly what central banks intend. They intend to crush the speculative fever. They intend to crush the overspending on credit, which they're starting to have a significant impact there. They intend to deflate housing because housing is 30% of the CPI, Jim, and housing is where most of the inflationary pressure has come from. And we're seeing in the recent data, that the CPI this week of the U.S. came off sharply from 9% last June to 3%. But the problem is they want it to get back to 2%, and that's the target. And to get there, we really have to go after housing because it just got so bonkers during the pandemic wave when, housing was going up 50% and rents were going up, and it was all premised on, as I say, nearly free money.
Are present cash deposit rates an indicator of what's ahead?
No, actually, what I'm describing there is that, the cash deposit rates or the investment savings accounts, GICs, that very short-term money, T-bills, they go up and down with the bank overnight rate. So because the rates have jumped as quickly as they have since March of 2022, people have gone from, some of those instruments were offering less than 0.5% to now offering, more than 5%. So that is a function of this rapid rate hiking cycle. And that's great, but the problem is that that short-term money is also what will fall as the central banks go back to cutting interest rates again in 2024. And I anticipate that they will do that in response to a recession because that's their mandate. They're supposed to try and buffer the downturn, even as they create it with the rapid hiking cycle after leaving rates so low for so long. So that means that we should take advantage of these rates as a place to park capital now, safe from the storm of all these bursting bubbles and asset markets that are in turmoil. It is great. It's very healthy and lovely to be earning a decent return while we wait in some of these safer instruments, but they are indeed the ones that will also drop quickly when rates start to be cut again. So we shouldn't expect them to last indefinitely, I guess is my point.
Are the banks constricting credit?
Absolutely. So what I'm describing in terms of the quantitative tapering, the withdrawal of liquidity from the banking system, that's part of the function of what's going on. The other thing is banks are starting to see defaults spike, so they're concerned about bad debts. They're having to start to set aside reserves for bad debts, which reduces their profits. So they're starting to do more of that. 46% of U.S. banks reported in the latest survey that they have been tightening standards for business lending and for consumers. So it's a function of a lot less loans are being made. That's a function of, as I say, the institutions who do the lending becoming more careful because they're starting to see the defaults and the distress, and they're concerned about bad loans. So they've tightened who they'll offer credit to. But it's also a function of deterioration in the balance sheet of the individuals applying, right? So the income gains have not nearly been enough to keep ahead of the borrowing cost increases that have happened. And so that means that people are just qualifying for a fraction. Again, if you go on any mortgage calculator today, Jim, and just sort of play with the numbers, I think people might be really surprised at how little one can qualify for now at interest rates of, 7%, which is essentially all Canadian mortgages, the fixed terms, floating fixed terms, all that is around 7%. Now consider that you have to qualify for some of these things on a stress test basis with the rate being offered plus 2%. So if you look at the calculators, someone that's making $200,000 a year, Jim, and has no other debt qualifies for a maximum loan of about $650,000 today. So considering that the average home in Canada is still north of $700,000 and in large centers north of $1 million, you can sort of quickly see that there's not that many people who now qualify for financing for things like homes at current prices or cars. I mean, I was just looking at some of the car credit websites, and some of those car lenders are literally closing and going out of business. So there's a lot less availability of even car loans. But those that are on offer are north of 8%. So this is just a fundamentally different world than any people that, the people are in their 20s and 30s, that sort of thing, or were not aware of this cycle in the prior 2008 period. They really think they've woke up in a nightmare here. But this is really more what normal conditions look like. It's just we were through such a period of strange and unusual conditions.
In a post this week on jugglingdynamite.com, you mentioned that the corporate bankruptcy wave has just started. Once corporate bankruptcy waves get started, how long do they last for, and how difficult is it to put an end to them?
Yeah, well, see, bankruptcy waves in general start after the hiking, about now is about typical. So 2023, we've seen a big jump in that. But again, if you think about it, it makes sense because central banks were hiking rates really quickly through the last 16 months, but most most companies or individuals that didn't have floating, their floating rate debt was going up lockstep pretty much with those increases, and so they felt that pain, blow by blow. But when you're talking about a lot of companies during the pandemic, just like individuals who took out mortgages, 5-year terms locked in at 1.75, well, they haven't felt the increasing rates cycle yet. And it's only the variable rate mortgages, of which there's a significant amount, like 50% have been floating up with these rate hikes, and those people are really their hair is on fire right now because they've lost so much free cash flow with the increase in payments. But when it comes to companies, certainly the publicly traded companies were issuing debt in the public markets and raising capital that way, and as I say, getting it for a song during the pandemic. Many of those are, finite terms, 2, 3, 4, 5 years. And so it's not until sort of the year before that money's coming up for renewal that they start looking around to see how they're going to replace that capital. And if they don't have cash on the balance books, which most of them don't, to pay down this debt, because they've become so highly levered in recent years, they then have to try and find alternative financing. And that's when they look at market rates where they were able to borrow below 5, and now the market's saying, well, if you want us to buy your bond now, you're going to have to pay us more like 8.5%, 9%. So that is a huge increase in carrying costs, and that's why it takes some time for that to filter through. And typically, as I say, about a year before the term comes up is when they start looking at this financing, and that's when they come to this realization, wow, we can't actually extend and pretend any further here, and they start doing filings. So we've seen a spike in the corporate bankruptcy filings akin to what we saw heading into the 2008 cycle already, but it tends to go on, it tends to peak well into a recession and even after the recession because of this lagged effect of this refi and when money's coming up and all that sort of thing. And then the banks, of course, are the ones who make the loans to the small and medium size, the non-publicly traded companies, and they're the ones that are definitely restricting loans, and bank companies are starting to run to the end of their credit facilities. And don't worry, don't forget that a lot of those floating rate facilities that corporations, often will rely on for operating facilities, that's the kind of thing that's prime plus. Prime being something that's floated above 7% now, plus something, 1.5% or so is their short-term money costs. Well, again, something that they were paying 2 and 3 and 4% on, now being that much more is really just a huge hit to their liquidity and ability to function.
With work from home, shopping on Amazon, and corporate bankruptcies, is commercial real estate in trouble?
Well, yes, indeed. And again, we're seeing the strife and stress spread through the commercial sector, but it was also a function of this low rate era where, anybody with a pulse could get free money or cheap money and throw it at things. And that does not, make for the smartest investment decisions. So definitely we saw a lot of private equity, private debt, venture capital, all these people running funds or, pools and plowing it into the commercial realty space. And it just got dramatically overbuilt, oversupply. And again, a lot of that credit was borrowed dirt cheap. Now, the thing with commercial real estate borrowing in those pools and funds, the BlackRocks of the world and that sort of thing, they basically will just hand the keys back to the lenders or just, say, we're out, we're not servicing that debt anymore. And they've been starting to do that as well. Now, the other tricky bit comes because there was so many of these, well-funded, highly levered participants or investors, if you want to call them, speculators in that commercial space. They got very concentrated in a lot of very expensive properties. And it turns out it's just like in housing now. A lot of people in the next year and starting now are going to want to sell those properties, are going to say, hey, we've got too much overhead here, this is terrible, we've got negative carry, it's taking all of our income and more just to try and function and pay these debts and the overhead required. Let's sell it. Of course, that increases the amount of properties listed, which we've seen a real dearth of properties on the market in the initial stages of this, because people are kind of like deer in the headlights, frozen. They can't believe this is happening, and there's kind of this belief that surely central banks are going to ride to the rescue soon and start cutting rates again really quickly, and there's just no indication that they're going to do that really quickly this time, because, as I say, for the first time in many years, they're concerned about reviving the inflationary impulse. And so they're saying, no, we're going to have to hang tough here for a while. And that's why I think you're going to see a lot more of these highly levered owners in commercial and residential, and certainly the multifamily area where a lot of these companies were buying up whole neighborhoods to rent them out. Not just that, but you've seen a lot of people doing the VRBOs of the world, the Airbnbs of the world, where they had multiple properties on the expectation that there would be a lot of people seeking to rent them. Well, you get into an economic downturn, of course, you get both a decline in those who are interested or able to rent. At the same time, you get a lot of properties coming on the market desperate for income, and that ultimately culminates in more listings. So I'm pretty confident we're going to see an increase in listings that will come as central banks hold the line here and rates are uncomfortable for so many people, and that will then lead to eventually, we've seen prices come off already. In some of these commercial spaces, the distressed selling is just beginning, and indeed they're finding a hard time just even finding someone else with the deep enough pockets who can buy some of these really expensive properties. They're being written down in some cases, 30 and 40% in market value before someone will step up and either qualify for the financing to buy them at that level. So that's certainly going on in the commercial space, and I think we're going to start to see, some pretty dramatic cuts in the residential space as well.
There are rumblings of a housing market crash ahead for Canada, and especially in the bubble cities of Vancouver and Toronto. Are you seeing any indicators of a housing crash ahead?
Well, I think housing crash is a very, subjective term. I think it would be entirely reasonable, given the magnitude of the big jump that happened, and all the bananas behavior of people piling into $1 million loans and all sorts of craziness when rates were so low. Again, that was such a bad incentive for destructive financial decisions. So I think it would be very typical to see housing prices come off, 20, 30%, depending on the area, depending on the price level. Certainly, as I say, the typical or average Canadian household cannot afford to buy any properties that are listed, sort of north of 750 in this environment. It's just not a thing. And a lot of properties are listed well over $1 million, $2 million. I live north of Toronto. It's very typical to see, properties listed here north of $2 million, and many of them have been sitting for many months now. And I know why when I do the math. It just doesn't make any sense, the fraction of people who can afford them. So I think, I don't know if crash is the right word. It's not a word I would use, but I would say a 20 to 30% decline would be entirely in line with historical norms in this environment. And the thing that I think is something that's not widely understood is that they tend to take several years to bottom. And this is the point that, you can see. We did see a sort of quick downturn in 2008 in Canadian real estate. In many markets it dropped 20%, but it was a quick V and right back up again, right, with all the incentives they brought in after the great financial crisis, and the fact that Canada, for example, was much less indebted at that point than it is today. But I think that was not a typical housing bear market. A typical housing bear market is more akin to what we saw in, the late 80s or the early 80s, and the housing markets in the U.S., for example, after 2006, where you get a multi-year decline, before prices bottom. And again, you're having to see wave after wave of people capitulating, owners capitulating, saying, I can't maintain this any longer, I'm sick of losing money, and that's ultimately which brings the waves and waves of lower and lower prices and finally flushes out the system. So it typically takes a period of years, not months.
It looks like a significant number of jobs created are working for the federal government. Does this hide what's really happening in the economy?
Yeah, for sure. And we've seen that trend. What we've noticed is that, again, with the increase in costs of borrowing and how many people who came into this rate shock with very high levels of debt, we've got a big drop-off in self-employment in the economy. That's a sign of a sick, ailing economy. New business startups have reduced significantly. Again, the spike is more in bankruptcies than in new businesses. Self-employment is coming off. And the government was a major employer. During the pandemic, the employment growth from 20 to 21 really came from government employment. But even it's been flat year to date because governments are also facing very unfavorable math, let's face it, with the huge jump in their borrowing costs as well. And any new debt that has to be floated is they're staring at the highest rates they've seen in more than 20 years, which takes a greater amount of their cash flow as well. So we in Canada tend to have, a lot of employment in very cyclical sectors, like, for example, energy, the oil and gas industry, and financials, which, again, very cyclical, very impacted by all of this. As I say, the Canadian unemployment rate is now up to 5.4% in the latest data. It's likely to go higher by 1% or 2%. Typically, in a recession, you would see the unemployment rate peaking well after the economy has bottomed. So again, it's this lagged effect where employers try and hang on to employees as long as possible, especially since they had a hard time hiring during the pandemic and getting bodies, and they don't want to let people go unless they absolutely have to. But when it's an extended drawdown, not a quick blip like we saw in 20, but an actual recession that lasts many months and possibly quarters, that's when you ultimately see a lot of people finally blinking and laying people off. So I think again, the federal government can't give us all jobs. We need to actually revamp the economy and improve productivity and cut a lot of the deadwood and the misallocations that have happened. And in doing that, we can then revitalize and start creating jobs again.
Do you expect a strong or weak Canadian dollar for the second half of the year?
So this is an interesting race because the U.S. dollar index as a benchmark against the major world currencies has actually fallen significantly. It's back testing the 100 range. As the tea leaves look like central banks are very near the end of their hiking cycle, and the U.S. Fed, as I say, may go again in July, maybe once more in the fall. But as soon as we're at 5.5, they've already crimped off so much of the economy. And so the dollar index is a reflection of currency traders basically saying, I don't think we're going to get a higher rate differential now in the United States if we sit in the dollar because they're likely at the end of the hiking. So that's one of the factors you start to see weakness in the U.S. dollar. But again, it's a race relative to what, right? So relative to, we know that when we go into global recessions, and I think I intimated at the start that the Chinese data is really horrible. When we start to go into global recessions, you typically see a flight to safety where people choose the U.S. dollar, also because they're having a big funding crunch as well. Don't forget there's a whole bunch of countries in the world that own a lot of U.S. dollar denominated debt. And so as the rates go up in the U.S., so too do the cost of carry in their having to service those debts as well. And so the stress becomes, a crunch for U.S. dollars. So although we've seen weakness of recently, and that has been a boom under, you've seen a big sort of relief rally this week in this idea that, central banks are probably near, the U.S. Fed is probably near the end of their hiking cycle. They may actually, intimate something like that at the Jackson Hole conference in August is typically where they slip something like that in. And if they do, so everyone's sort of like, thank God they've stopped. They're not going to keep hiking. But here's where the rubber meets the road, because there's a lot of false understanding of how that works, and the assumption being that if they've stopped hiking, they'll soon slash rates again. But even historically, the average pause between the last hike and the first cut is 8 months, and sometimes it's been as long as 13 months, like it was in the 2006-08 downturn. It took that long for them to sort of be worried enough about unemployment rising that they went back to trying to cut rates. And so I think that the gap here is going to be a lot longer than people expect, and the Canadian economy, as I say, being overly dependent on finance and oil and gas again, which is 50% of our TSX, which is a huge percent of our, and the housing being the bulk of our GDP growth in the last decade. All those factors are all on the wrong side of the trade here. So I think that the U.S. dollar is going to outperform the Canadian dollar as we head into the next, the back half of this year. The Canadian dollar has rallied a bit year to date on this risk-on trade, this, belief that the central banks would stop hiking soon and all would be saved. But traditionally, that is not how it works. And indeed, the stock market, which most people don't understand this, the stock market typically bottoms, some 12 to 30 months after the last hike. So we could be in for the very worst of the down cycle now, both in terms of unemployment, that would be typical, in terms of the housing market, and in terms of the stock market. So as those factors evaporate, this so-called wealth effect that people have seen in the past couple of months, I think you're likely to see disappointing data in Canada, even the US, and that Canadian dollar is likely to weaken.
With the blessings of the Conservatives and the NDP, Prime Minister Justin Trudeau continues to give away money to other parts of the world, money we don't have. Could this cause inflation to continue higher and higher until this spending spree stops?
Well, actually, no. Adding on more and more debt is actually disinflationary. It depends what you're putting it into, right? So originally what happened during the pandemic is they put a lot of borrowed money into the pockets of consumers and businesses who spent it in the economy, and that was indeed inflationary. But if they're, when we talk about, other parts of the world, money going away, et cetera, it's very much a question of to what and to what end. If it's preventative investment, if it's productive investment, if it's to do with a strategic allocation of resources, to either improve our productivity or reduce costs, reduce waste, protect interests in different parts of the world, protect resources potentially in different parts of the world. Some of that can be very strategic and important and, stable, disinflationary for the country. It's a function of what you're putting the money into. So if you're just subsidizing irrational, destructive behaviors like speculation in real estate, for example, and you're adding debt to do that, then yes, that can be inflationary in the short run, but ultimately the weight of the debt is disinflationary or deflationary, which is the part of the cycle where we're now getting to, where people are realizing that, their payments have increased so much they now can't afford to spend on most other things. So the whole thing about debt is that it ultimately suppresses spending, and that's why it's disinflationary typically in the longer run.
What stock market sectors are you currently watching?
So the most important ones in terms of this bear market rally, and I do believe it's a bear market rally we've seen since October, the leaders of that have been this very small handful of tech-related companies, primarily in the AI space, right? This idea that artificial intelligence is the next big wave and that's going to be a no-brainer. So there's been a lot of no-braining going on, Jim, a lot of money flowing into things at ridiculous multiples of sales and revenue and earnings, if they even have earnings. Some of these companies don't. So we've seen a lot of that. And the interesting thing about the U.S. tech concentration now in things like the S&P index, the top 10 stocks, is now even higher than it was in the dot-com mania. It got to about 25% of the S&P, the handful of the top tech stocks, and it's above 30% of the market cap today. So it's bonkers. It makes no sense. And the thing is that even some of those tech companies, you've got the it's a huge demand that was driven during the pandemic when everyone was buying tech to stay home. That's behind us. We've got an overhang now from that. China was accounting for a huge chunk of the revenue of some of those tech leaders, the Qualcomms of the world, the Apples, the Microsofts, the Teslas. A lot of their sales were going to China, and there was this reopening trade or expectation that they were going to have a big rebound in domestic demand, which has not materialized. China is very much disappointed in the last 12 months. So I think there's that. And also, I think it's the good old-fashioned when you overpay for something, the mean reversion is just that much stronger. So I think that I'm watching very carefully these last handful of tech holdouts. And, for example, the financials typically lead this cycle, as I explained, with the credit cycle, and the financials are still off hard. The Canadian financials are still, about negative 16% and flat year to date, basically from where they peaked in 2022, and the same with the U.S. financials. The commodity sector has rallied again, as I say, on some U.S. dollar weakness in the last little while, but the main components are still in a very, very much in a bear market. Whether you're looking at oil, whether you're looking at natural gas, whether you're looking at copper, these things are well off their peak from even 2 years ago. So I think the downtrend has been punctuated by this tech-led euphoria again, but I expect that weakness is going to come home to roost. And just as I explained with the commercial real estate sector, and when you get all the people piled into the one thing, when they look for liquidity, which happens because they have been over-levered and haven't kept enough cash or dry powder, they look for who's going to buy. And, of course, they're all trying to sell the same thing. And the same thing in this case is the Apples and NVIDIAs and Microsofts of the world that, all these index tracking portfolio managers, which and automatic payroll deductions going into indexes, so there's been very little analysis or thought. It's just all a percentage of pay each month goes into this index, and then that forces buying of these ratios. The problem is that those concentrations work the opposite way when people try to sell, right? Or when people lose their jobs and those payroll deductions are no longer going in, and or they need to liquidate some of their so-called investments in order to pay for their life. And then they find that they start selling. Well, if 30% of the S&P is in the same 10 stocks, and it is, as an example, or 50% of the NASDAQ is in these same 10 stocks, and it is, and you've got a whole world of funds and managers and portfolios that are replicating these indexes, thinking they're diversified, but not realizing that they're so heavily exposed to these same handful of companies, then those are the ones that are most vulnerable when the selling sort of spreads, and that pulls the benchmarks down much faster than anyone thought possible. And I think that's the next phase of this. So we're just watching very closely for both the cyclicals have not recovered, have not rebounded year to date in any significant way. 495 of the S&P 500 companies are flat year to date. The Russell 2000, which is much more economically sensitive, has not participated in any way in the rebound we've seen in the past few months, like these large cap tech stocks have pulled everything forward. So I think once the generals go, we expect to see that the downside will be shocking to people who think they're in these diversified holdings.
What safe havens do you like for storing wealth in uncertain times?
So, as I said, you get the best rate of return on investment savings, whether it's money market, whether it's T-bills, government bonds. Government bonds, even the longer dated stuff, has sold off with the rate hiking cycle, and we're getting the best yields there that we've seen in many years as well. So I like the cash-like equivalents, the short-term, the government bonds, even some of the longer dated stuff now, because what people don't understand about bonds is that the corporate debt tends to trade with the equity cycle. So if I think that the corporate equity cycle has further downside, that suggests that we're going to see a blowing out in spreads for corporate debt, which means prices are going to fall there. That's not recession proof, but the government bonds are one of the few places that typically attract capital in this environment as the recession unfolds. So I like the highest quality credits that one can have, and not so much in the fund versions, because they have a whole bunch of complexity that I won't get into, but it's more the individual securities. And I think, people should understand that cash is really an excellent thing to be in this environment generally, as one of the few safe havens, but also because you're being paid now so handsomely to take on no risk in the market. So that's all kind of my suggestions.
Are more and more people, switching to electric vehicles?
Well, sure. Vehicles in general are in a major downturn in terms of units being purchased, and that was before the recent, rate hikes. Just in the last year, we've seen a drop in the amount of vehicles that are being purchased as rates have risen, as I say, now back to more like a 9% car loan. But statistically, if you look at the trends globally, 1 in every 7 cars globally is now an EV. That was the 2022 data, and the conventional car sales are down by 25% over the last 5 years. So the sales, all cars are going to be in sort of hard to sell in this environment with rates so high and people so cash strapped. But the interest or the growth in sales is definitely going to the EVs. And that's where people can, the prices have come down significantly. Tesla led that with a lot of price cuts in the last 6 months, but they are definitely, at the same time, the amount of range that you can get out of a battery has leapt in the last 10 years from, sort of 250 miles per charge to now more than 500 miles per charge for some of the best EVs like the Teslas, which are so far ahead of everybody else in terms of their technology. But the point is that is where the growth is, and they are now coming into a very competitive price with sort of your standard other types of cars, and the operating costs to run the EVs, there's just a fraction of what the other cars are. So it's a no-brainer for anyone. Again, if you look at the math, if you look at the data, the longevity of the electric vehicles, the fraction of the repairs and maintenance, and the cost to run them are so cheap relative to the ICE vehicles that it makes incredibly more sense for anyone that's looking at how to be financially efficient, and I think more people will be. Having said that, I expect all car sales to be having a rough go for the next year or so.
What does a person's net worth need to be in Canada to be considered wealthy?
Well, I guess that depends on what your standards are, but generally speaking, if you're talking about a billionaire, there's about 63 billionaires in Canada, but the median household net worth is about $380,000 nationally. About 4% have net worths over $1 million. Less than $1 million. Less than 1% have assets in the $1 to $5 million range, and I'm talking about net, right? Not with debt. I'm talking about assets minus debt. So that's all in terms of the balance sheet or the asset size. Most people are talking about what they earn and what they have in terms of cash flow. The median household income in Canada is about $96,000. Just 8% of the population make over that per capita. So it gives you some more of a sober insight. About 514,000 Canadians out of some 40 million today have household income of $200K or more. 514,000. So again, when I was speaking about who can afford to buy housing, and you look, you put into a mortgage calculator that if you have $200,000 a year of income and you have no other debts, you can only borrow a maximum of $650 on all accounts for credit today. It gives you a sense. That's that 414,000 Canadians who can do that, and everyone else can borrow a lot less than that, right? So 3 million people, or about 8%, have a per capita income of $100K. So I think that maybe gives an answer to your question, but it's a lot. People have a lot less money than most imagine or think, and that's because of the wide proliferation of debt. And as I said, when rates were next to nothing, that felt one way, and now that they've come back up to more normal ranges, historically normal, then that is people are realizing they're not nearly as rich as they thought.
So it's time for Scotiabank to change their slogan from "You're richer
Jim,
than you think."
I've been hoping they would do that for many years, and they still, I guess it works for them. They've had awesome debt sales with it, but I'm hoping we get to a time where that's so embarrassing and that we're back to encouraging people to do fiscally prudent things like pay down their debt and build up their savings and stop taking really crazy risk. And I'm really hoping that this next recession might be the final catalyst to change behavior, and generationally so.
Where can people follow you?
So my blog is jugglingdynamite.com, which I've been writing for more than 16 years now, and basically I write articles on there every day and share clips, links, and segments that I think are instructive or important in terms of where we are in financial cycles and the economic situation. And then venablepark.com is our firm website if anyone's interested in what kind of financial services we offer.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel, Incorporated. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Danielle Park. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.